Hello and welcome to this week's special presentation. My name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's topic, which is titled Protecting Profits. Now, this is a presentation that we've done more than a few times over the years here at VectorVest, and I'm going to talk about 8 different techniques that we can use to help you protect your unrealized gains and the profits in your portfolio. Understand that, there's a lot of macro uncertainty, geopolitical uncertainty, and we all need to be prepared on how to protect those unrealized gains. So that's what I want to focus on here today. And a lot of it is driven by this quote I've been using here at VectorVest for years and years from Mr. Mark Twain. He said, "Don't just sit there and worry, be proactive, do something, anything about what's worrying you so you can gain information, focus, and control over the situation." He goes on to say, "I've suffered a great many catastrophes in my life. Most of them never happened." So this is kind of the mindset we want to have. I want to be prepared. I want you to be prepared to protect those significant unrealized gains and even stocks with smaller gains in any position in your portfolio. Let me jump into the program for just a minute. Now, we have a great bounce back today. The PCE numbers came out as I record here. The market is up pretty dramatically today, but we've seen a lot of volatility, and these kind of days is all the more reason for me that I believe it is important to understand how to protect profits as you see them. Now, if I come into a market timing graph, I have a 2-year graph here. If you've been using the VectorVest program, hopefully you've been able to, in this uptrending market over the last couple of years, profit and have some good profits in your portfolio. Again, we have had a lot of uncertainty and sideways movements and some dramatic pullbacks, but overall, there's a profit there. And if I take that a step further and come into some of the model portfolios that I use in our retirement coaching group, you see we have some really good performances, whether it's longer term, 5, 6, 7, 8 years, whatever it might be. We have others that have been in place for maybe a year and a half, prima donnas. These are some great returns that we see here. Pale Blue Chips is an investment system that we use. It's got Broadcom in there, an 87% return on investments. What can I do to protect these types of unrealized gains? And that's really the goal here for what I want to accomplish today. Let's just jump right in and talk about technique number 1. And we're going to use stop orders, right? It's a very common thing. Dr. DeLito discusses the topic of stop orders in chapter 14 of Stock Strategies and Common Sense. I'll show you in a moment how to download that from your training tab. But there are several types of stop orders available to implement when selling stocks. We have our basic, just either a percentage or a dollar amount stop loss. You have stop limits. You have trailing stops. So there are many different stops that can be used. What I wanted to focus on here, if I come into a graph, and I'm going to choose, there's many positions in here I can use. I've got Eli Lilly here, company. We have an 82.5% return on this stock. The stock is down a bit. Let's go ahead and take a look. So if I pull up a graph of the company, what I have it set to is just the VectorVest layout here that can be found under the graph layouts. And of course, there's the 40-day moving average. I can lay over that along with the stop criteria, the VectorVest stop criteria, which I'll talk about in a moment. Let's start by looking at the 40-day moving average. I'm going to take the stop off for just a moment. Now we can see, remember, we have over an 80% gain in this particular stock. We see that the stock has fallen below its current 40-day moving average. But you can, of course, adjust that to the current position that you're in, and I can extend the moving average period of price from 40, and let's just say I want to put it to where it's trading right now. And then you can determine, is that going to be my support? Is the stock going to come back? How am I going to manage this position? It's just one way that you can look at that and adjust that and kind of draw your line in the sand, as we say. So that's one way to do that. You can always adjust or use any technical indicator that you are inclined to use. The other thing I can do is use the VectorVest stop. Now that is a moving average. It's a 13-week moving average of the price of the underlying stock. that is adjusted for fundamentals. The better the fundamentals, relative value, and safety, the looser that stop criteria becomes. If fundamentals are not great on the underlying stock, it tightens that the VectorVest stop price. So that's another great way. If you currently own Eli Lilly, it's been a buy or a hold for a long time now. Again, the stock's had a wonderful run to the upside. You can continue to use that. Now you can also see that number if I go to our viewers tab and I go to stock viewer, and you can see that stop price, again, the 13-week moving average. So it's a great way. And when that, by the way, when the stock falls below that, the rating or the recommendation on the stock becomes a sell. So stop orders are an important way to manage. You can tighten your stops anytime you'd like on any position that you have to lock in those profits. Technique number 2, I'm going to talk a little bit about selling covered calls. We'll talk a little about options here. This is not meant as an option training course here. It's not my intention. I just want you to know that there are techniques out there. If you're not familiar with selling covered calls, it is the most popular, probably the easiest income trade there is out there. And the beauty of covered calls is that they can also be used in a defensive measure. So if you're not familiar with covered calls, a gentleman named Lee Lowell wrote a great book called Get Rich with Options. Dr. DeLito had recommended to our education department here. We read through it. And one of the greatest definitions that I've seen of a covered call, if you're not real familiar with them, was given here. And he wrote, if you own shares of stock and you're not selling calls against them, you're throwing away free money. And here's the definition really of what a covered call is. There are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. Let me say that again. Somebody's going to pay you money today to take your stock away at a higher price. Okay, there's a lot of reasons to sell covered calls. One of them is to become defensive when you believe the market might be moving against you. So just a quick look at a risk graph. Down below on the x-axis is the price of the underlying stock. The profit and loss is here on the y-axis. So if you're just long a stock, it's easy to figure out, right? Stock goes up, you make money. Stock comes down, you lose money. That's how we manage those. When we look at a covered call, there's a couple of pros and cons to this. We sell someone else the right to take our stock away at a certain price by a certain date. If that stock is called away, right? If it's called away, the worst case scenario is that you make money, right? You get to keep the premium that the buyer paid you, plus whatever capital appreciation, depending on the strike price that you sold or where that buyer took your stock away. Okay, so it does cap your upside potential, but it also lowers your cost basis and lowers the risk. And so you build in a cushion or a stop price. So your max profit is capped. Your break even at expiration is whatever you paid for the stock minus the premium that you received. So it's a great way to lower your cost basis. And then the risk is limited to the price going to zero, which it would be if you simply own the stock anyway. So that's the max risk of the position. So it's a great way. Again, it won't protect you on the bigger drawdowns on the stock, but it does build in a cushion, and especially stocks you're holding for the longer term allows you to get through those toppy markets or those uncertain times. So selling covered calls is a great way to help protect profits. Let's talk about technique number 3, buying put options. Now again, buying puts is used as an insurance, right? When you purchase it against the stock you already own, or you can do it on an index ETF, which I'll talk about in a few minutes. Remember that the value of a put option rises when the underlying stock or ETF, when that value falls. So as such, it offsets the damage to your asset, just like an insurance policy. Right? That's the way you have to look at it. There's 2 reasons to buy put options: to profit in a downtrending market or to protect an underlying asset. And so the mindsets are a little bit different. If I buy a put option to protect a position that I have with large, significant, unrealized gains, then it's okay if I lose money on that put option. Right? It's just like an insurance policy. Okay, so it's a very important way to be able to do this. I have just a quick, again, definition here on the risk graph, the stock price. There's what happens, right? The stock price falls, the value of the option will rise, right? So when you buy a put, the expectation is the stock will fall. Your risk is limited to the price that you paid for that option, and your reward is unlimited. I have it in parentheses because technically it's to this underlying stock going to zero. Okay, so that's the anatomy of being long a put option. Just a quick example, this ABC stock at a given point in time, I just wanted to illustrate it. And during earnings seasons, which we're in now, it's a very important time to understand how to do this. So you own a stock, you've got a nice unrealized gain, you do your due diligence, you know earnings is coming up. In this case, it's just an example. Actually, this was a live example from our coaching group a while back. You buy a put option. Okay, the stock's trading at around 211. You go out to protect the unrealized gain that you have, and you buy the right to sell this stock at $210, right? When you buy a put option, you're buying the right to put this stock to someone else at $210. What happened? Earnings came out, the stock gapped down, and the value of that underlying option on the day that it gapped down was at $985. So you lost about $1,500 or $1,600 on the price of the underlying stock, but you gained back almost $1,000 of that. You mitigated that loss because you were able to have an insurance policy in place. So just a quick illustration of the power of buying a protected put. Technique number 4. You can easily combine techniques number 2 and 3. You can combine selling a call and buying a put. What it does is allow you to take the premium and the cash that you take in when you sell that call and use that money to buy the protective put. So the core piece of this puzzle here is the insurance on buying the put. Selling the call simply helps you pay for it, right? It's known as the collar trade. And again, a great low-cost way to buy insurance. So let's take a quick look at the risk graph here. So again, you're already long the stock. You go out, you sell a call, you use that cash to buy the put. It's the simultaneous sale of an out-of-the-money call and a purchase of an out-of-the-money put. Same type, same expiration. And again, the objective here is simply to reduce the cost of buying downside protection. What it does is it does make it a defined risk position. So because you have the put option, right, your risk is limited to the downside. And again, it does cap your upside potential. But remember, you already have significant unrealized gains. So the worst case scenario, if it's called away, is you make more money. Technique number 5 talks about buying index put options. Now, if you own stocks in your portfolio from a particular sector, like tech companies, you could use the Qs, the ETF that tracks the NASDAQ 100. You can use the SPY if you have, stocks like the Magnificent Seven type stocks. But buying index put options is a great way to protect your overall portfolio in uncertain times. So instead of going out, as I noted earlier, and buying an individual put option on each individual stock, okay, you can come out and you can buy one put option on an index ETF. For one example is the SPY, right? You buy a put just on that. Quick note, a lot of folks will always ask, well, how many puts, do I need to protect my portfolio? Here's just a quick, easy formula that we use. It may not always protect it dollar for dollar on a dramatic move to the downside, but it does protect pretty good. So the current price, or roughly the price at this point of the SPY, the ETF that tracks the S&P 500, is right around 543. You can go ahead and buy 2 or 3 put options on your $100,000 portfolio, right? You could just fill in the numbers based on this formula that we use. Okay, so theoretically, if you bought a put option on SPY at 543, God forbid, the SPY goes to zero, you would profit $54,300 less whatever you paid for the put. So if you had 2 contracts, you would cover a $100,000 portfolio. You can buy 3 or 4 contracts. The key is to understand you don't have to go out and buy 20 contracts and put, a large sum of money into your protection of your portfolio using put options. This is just a quick example from our coaching group we used. This was just last Tuesday, the 23rd. We set up, this is actually a bear put spread, but the core of it, again, was buying a 555 put on the SPY. And the next day, the market, that was the tremendous sell-off we saw in the market. And I went ahead and covered it. We bought the position at 3.25. We sold. I closed the position at 665 just the following day on the huge move to the downside. That's a $3.40 profit on that position. On the 5 contracts, turned out to be a $1,700 profit. So again, just an actual example of being able to protect your portfolio. Another great way to protect your portfolio is buying contra ETFs. We have several searches located in the ETFs folder in the Unisearch tool, which will guide you to contra ETFs that are poised to profit in a downtrending market. I'm going to come back into the program and I'm going to click on the Unisearch tool along the main toolbar, and you'll see here our search directory. And as I come through, I can look for the ETFs. And when I click on that folder, when I see the red arrow or triangle there pointing down, these are the contra ETFs that I could look for. I can choose buying contra ETFs. It's going to set up the parameters there. And I can easily find some good performing ETFs. Now, these days, now we have them on individual stocks, so you can walk through that. And there's a great way to find these, right? Another great way to do that is to go to the Viewers tab and go to the Watch List Viewer, and there's a folder there for ETFs as well. And you can see the contra ETFs. Just be sure you know which ones that you're purchasing, right? There are leveraged ETFs. You may want to be careful with the triple leveraged ETFs. They're a lot more volatile. It's going to be up to you, but here is where in the VectorVest program you can find these contra ETFs. Let's go ahead and take a look at technique number 7. Now here you can hedge with short sales. It's a great way. Listen, if you're experienced at shorting stocks, you can continue to hold your longer term current positions, right? And you can go out and short stocks. Basically all you're doing is borrowing a stock from your broker, selling it, and hoping to replace that stock, and the stock moves down, you could buy it back at a lower price. That's all shorting stocks is about. You won't be able to do it in your IRA account. So if you have a retirement account, you'll need to either buy puts or the contra ETFs. But hedging with short sales, if you feel comfortable doing that, is a great way to do it. We do have in the VectorVest program, you can come to the shorting searches that are found here. Searches short would be the best folder to come in. There's a bunch of searches here. Really, my favorite one here is worst stocks over 20. So you want to find some crummy stocks that are likely to go down in a downtrending market. Here's the place to find them. That's the idea behind shorting stocks. So another great way to do it if you feel comfortable shorting stocks. And then finally, technique number 8, sell your stocks. You can just sell them outright. Right? It's the surest way to protect unrealized gains, and you can simply sell them out. Now, the question will certainly come up, well, what if I've owned Apple or IBM for the last 30 years? Every time we see some red lights in the color guard, you're not going to want to go out and just start dumping your stocks. However, if you're working through portfolios where you've owned a stock for, a shorter period of time that has worked out well for you, like the positions in this particular portfolio that I'm using as an example, you can go out and just close these positions and pocket the profit. Now, the risk is that the stocks continue to rise and you're going to give up some potential profits. But as Dr. D had once said, you never ever go broke taking profits, right? And you can always buy back into the stock if you choose to. And of course, keep in mind, you can always sell incrementally, right? If I own 120 shares of Broadcom and I have that type of unrealized gain, I don't have to sell all 120 shares, right? I can incrementally close the position piece by piece. I can add back to it as I see fit. So again, in these uncertain markets, remember there are ways that you can be prepared to be proactive instead of just sitting there and worrying about what's happening in your portfolio. So don't let those catastrophes happen. Be prepared. Thank you for taking the time, and we'll see you next time.